What about robo-advisors?
Robo-advisors, Betterment, Wealthfront are the ones that come to mind. But pretty much, I mean, even I have a robo-advisor on my website, and it's actually a pretty common tool, and that's what it is. It's just another tool. It's another do-it-yourself investment platform. I think for the right client, it works. Look, for a long time, we've had investments that were based on time horizon. Age-based portfolios is what they're called. It takes it a step further where you could dial down more specifically what your age growth or age-based portfolio could be versus someone who's a month older than you, for example, or younger. That's really the difference. But investors have been able to buy all kinds of investment products on their own through all the major financial services companies. So it's another offering in that group. I can understand there's appeal for younger investors who may be more do-it-yourself, but I find in my own experience, I think the do-it-yourself mantra of millennial investors is not as deep as I would have expected after reading about it in the media. I'm not knocking the media, I'm just simply saying that I find that a lot of millennials come to me for advice, they open up accounts with me, and they want the service and the guidance.
Next topic, what investing philosophy do you adhere to, and what strategies do you follow or use?
First and foremost, my philosophy is very plain vanilla. I consider myself the last of the Mohicans. I manage the portfolios. I select the securities. I don't farm it out. I don't outsource it. I do it in-house. It's a joy to me to do that, and I actually think that's my, what do they call it, the USP, your unique selling proposition. Okay, it's kind of a cheesy term, but that is one of the things that makes me unique. I manage the portfolios. I do it myself, plain vanilla. I don't get involved with the leveraged type products. I don't like to get involved with most of the products that the industry has put out, because a lot of them I don't find that they're going to do a better service do a better job of meeting the client's needs than what I could select for my clients. So the funny thing is, as far as risk goes, and that's one thing I like to talk about is risk management, because the industry has been coming up with ways to determine risk, many valiant efforts over many years, and that's where you get terms like beta, standard deviation, alpha, the Sharpe ratio, volatility. So the industry has tried to come up with many, many ways to determine the risk of a potential investment choice. But it's still, there's an element of faith, there's an element of hit or miss. I can think of plenty of blue chips that have disappeared over the years that we thought, were can't miss ideas. And then you have to match that with the client's own version of risk. So the philosophy is to really match a portfolio of securities with the client's needs, risk tolerance, time horizon. Now those are also, have become generic expressions in my industry. Time horizon, your risk tolerance, but you can ask 100 advisors and 100 clients what these things mean, and you're going to get a lot of different answers. So the idea is to assess the value, the risk metrics of what you're recommending, assess the client's needs and their idea of what kind of risk levels that they're comfortable with, and then you have to monitor it, and you've got to consistently view the accounts, speak with the clients, and make sure everything is where it should be in terms of a match between client and portfolio.
I guess, how do you go about selecting for the portfolio?
Well, there are 11 sectors in the S&P, in the economy. According to S&P, there's 11 GICS, General Industry Classification Standards. So you have financials, you have energy, you have materials, consumer staples, consumer discretion, technology. And typically a portfolio that I manage will be exposed to anywhere from 6 to 8 of the sectors. And within those sectors, I'm going to typically pick 2 or 3 of what I feel are best of breed in that space. I'm looking at valuations, I'm looking at highs, I'm looking at lows, I'm looking at charts, and then I'm picking what I feel are the best companies I can find in the space. And I use limit orders. Sometimes I buy and then I buy a little bit more, and a lot of the purchases are predetermined with limit orders. And the same thing goes for trailing stop orders. So if a stock has gone up a certain amount, 20%, I may put a trailing stop loss for some. I may sell some at the market, and I may hold some for a long time, but it's an indeterminate time. A typical holding for me, I expect it to be about 2 to 5 years.
Oh, wow. Yeah.